Dave Ramsey has a proven method for building wealth and creating financial peace, and it's not rocket science. In today's video, we're going to give you 7 action steps to help you create peace around the issue of money. And stay tuned to the end where we're going to give you Dave's secret formula for successful investing. Let's jump in. Winning at money is 80% behavior and 20% head knowledge. Knowing what to do isn't the problem, but actually doing it is. The Total Money Makeover plan isn't theory. It works every time. So let's break down Dave's 7 baby steps. And the first step is putting $1,000 away in cash.
And it sounds simple, and you started the video off with saying all of these things, it's not rocket science, and you would think setting aside $1,000 is easy, and this isn't counting towards your emergency fund. But believe it or not, 60% of Americans don't even have $1,000 set aside.
Right, and Dave always talks about preparing for Murphy's Law, because Murphy is always gonna hit when you least expect it.
Whatever can go wrong will go wrong. And as these things start happening, it feels like that is the truth.
Right.
Yeah.
And baby step number 2 is paying off all of your debt with the exception of your mortgage. And Dave calls it the debt snowball.
The debt snowball. It's a wonderful tool. And let me explain how it works. So you have your lowest balance here, and we want to attack this one. And so say the minimum payment is $200 and you have an extra $400 a month to pay off to your credit cards. Pay off the minimums to each of the rest of your credit cards and take the extra $400 and pay off that first debt. And continue to do that monthly until that lowest balance is paid off completely. And now you've got that extra $200 for the next credit card, so you have $600 extra to now go to the next lowest balance and continue to do that until all of your debts are paid off. So it's the debt snowball because you start to see these debts fall off of your balance sheet and starts to feel really good.
It builds momentum, it feels good, and it's that affirmation that helps you to keep going. And Dave even says, hey, if you have an expensive car with a really large monthly payment, sell the car. Don't be afraid to take some radical action, because he says, if you want to live like no one else, you got to live like no one else.
That was a great accent there. I think you did pretty good. Dave would be proud on that one. But one of the things I think of paying off debts is you may want to take the other route and pay off the highest interest rate notes first.
Right.
This isn't going to help you necessarily psychologically because the debts most likely are going to hang out for a longer period of time.
Right.
But at least if you have high interest rates, you're making more on your money that way. But they call that the debt avalanche, and just be aware there's a few different ways to tackle the debt, but find out which one makes most sense for you.
Yep. And then that leads to baby step 3, which is build a 3 to 6 month emergency fund. That's really your cushion and your margin that when Murphy hits, you're prepared for it.
And so talk to me a little bit about how do you look at 3 to 6 months? Should I have 3 months of living expenses? Should I have 6 months? Tell me more there.
So the way to approach it is if your job is really secure, it's you're not going anywhere with your job, maybe there's dual income at home, 2 workers, you could think about having 3 months. But if your job is not that secure, or it's maybe a niche industry and it's going to be hard to find employment again if you get laid off, then you may want to think about having 6 months. And certainly if you're a single income home, you want to lean more towards 6 months rather than 3. So that's why Dave gives you that range of 3 to 6.
Yeah, that's great. And we would hope this doesn't happen, but if you do lose your job, think about how long it may take you to get that next job. And so if you think you can get a job in 3 months, maybe that's the emergency fund. If you think closer to 6 months, that's another way to look at it too.
Right. And then step 4 is saving 15% towards retirement. So at this point in time, all your debts except the mortgage are paid off. You've got that 3 to 6 month emergency fund built up, and now you're aggressively saving 15% towards retirement. And this is where the controversy starts a bit, because Dave Ramsey makes these audacious claims that you can get 10 to 12% returns on your money. And this is where the financial professionals and the media really has a field day with Dave, and they argue that where are you going to get 10 to 12% on your money? So Matt, talk to us a little bit about this.
Yeah, I mean, 10%, 10 to 12 over the past 30 years or so, the S&P 500 has gotten about 10% rate of return. So we'd love to see you get 10% in your portfolio, but most of the people are having a diversified portfolio, which means they're adding different asset classes or different areas of the market to their portfolio to reduce some of that risk. And so to get 10%, if you were being extremely risky, it is doable, but most people can't handle the volatility. So we need to add some diversification. Another layer that you need to keep in mind is the taxes that could be due, and then fees and expenses that are involved with those funds.
Yeah. And in the book, Dave quotes several mutual funds that have track records going back to the 30s, 40s, and 50s. And so the point that Dave's making is that if you have multiple decades, yes, good rates of return are absolutely achievable if you give your investments the time that they require to actually grow and compound. And I think the problem today is that people are looking at these short little windows, 3, 5, even 10 years. I mean, Warren Buffett says 10 years is not enough to let the compounding effect work for your investments. So what Dave's talking about is a 30, 40, 50-year period. And if you don't think that you have 30, 40, and 50 years in your life, think again, because people are living out to their 90s. And so if you're 55 years old today, you have at least 30 to 40 years with which your money's going to grow. So I think people misunderstand what Dave's talking about when he says you can get 10 to 12%. I think that's a pretty safe assumption. The long-term rate of return for the U.S. stock market, as you said, is north of 10. So you just need to manage your expectations that in any given 3, 5, or 10-year period, you may not get anywhere close to 10 to 12%.
And you may not want to compare yourself just against the S&P 500 or the Dow Jones, just as a reminder to everybody. The S&P 500 is a great indicator of what markets are doing in the U.S. So it's the largest 500 companies in the U.S. alone.
Right.
So if you have international investments, then you can't compare yourself necessarily just to that.
Yeah.
And then the Dow Jones, you wouldn't believe how many people follow this as their benchmark, but this is the 30 companies in America.
30.
Only 30 companies. I wouldn't want to base what my portfolio is doing only on 30 companies.
Right. And I think Dave does a great job of really projecting hope, in which I do believe you can get these great returns over time. What I think Dave fails to talk about, though, is the experience that you're going to go through as an investor if you're trying to get 10 to 12% returns. Specifically, on average, did you know that the S&P 500 averages a decline of about 14% every single year? Every year. So watching your portfolio go down by 14%, that would just be average or normal. And so about every 3 to 5, 10 years, there's bear markets. We've had 15 bear markets since World War II, which is a decline of 20% or more in your investment portfolio. So the reality is there are many people out there who cannot handle the volatility that's required to get the 10 to 12% that Dave Ramsey's talking about. So really it's know thyself as an investor. And if you can't handle an average intra-year decline of 14%, or every 5 to 10 years watching it go down 20, 30% or more, then maybe you shouldn't have all stocks, and maybe you should reduce your expectations just a touch.
And so another way to say, you're saying that if I can't handle those ups and downs, I shouldn't expect those rates of return.
Absolutely.
Okay. So risk and return are related. If you can handle that risk, then yeah, you can expect those returns, but expect lower rates of return if you want to reduce those ups and downs.
That's right. And you can't ever sell when markets correct and they go down as they do. You can never sell during those times. And so if you are inclined to sell, which you shouldn't do when markets go down, then again, investing as aggressively as Dave talks about is not appropriate for you. So that leads to Dave's fifth baby step, which is start to build money, save for college to help pay for the kids to go to college.
Well, this is another controversial topic for us anyway, at least for me. The way I'm looking at this is most people aren't saving that 15% yet that's on the previous baby step. And they want to take care of their kids. They want to provide for their college education, which is fantastic. This is great that you want to help provide for them. But one of the things I say is that you can't take a loan for your retirement. They can take a loan for school. And I know that's a 100% against what Dave's saying about taking loans, but we'd rather see you be able to get up to that 15% savings rate before you start contributing.
Right. And I think the other great takeaway to your point is that you got to do baby step 4 first, which is be saving 15% towards retirement. And if you're not doing that, if you can't do that, you really shouldn't skip ahead to step 5. I mean, Dave gives a good prescription here. There's 7 steps in order for a reason.
Right.
And then that leads to baby step 6, which is get the mortgage paid off.
Okay, so we're making me be the bad guy today. The mortgages, we saw a lot of people get very low interest rates these last few years and getting locked in for 30 years of 2.5, 2.7% mortgages. And we're seeing interest rates in high yield savings now after the last 10 years of not getting anything. And so if you can get 4 to 5% in your high yield savings account and you're only paying 2.5 to 3% in your mortgage interest, it may make sense not to pay off that mortgage. Right. I see where Dave's coming from, but again, once you get to this step, I think there's a little room for some flexibility.
Right. I mean, we're all for getting all of your debt paid off, getting that mortgage paid off. It's going to create such financial freedom for you, financial peace. But to Matt's point, yeah, when you're going to get 5.2% on a money market fund and you're paying 2.5% to the bank, you can use, that's arbitrage, and you can use the bank's money to make money and help expedite that mortgage payoff. But bottom line, we do believe in getting the mortgage paid off at some point in time. The best way that you go about that, you just need to think that through. But then that leads to baby step 7, which is build wealth and give it away. And I love this one because it really speaks to having a generous heart and being the kind of person that makes an impact and being a blessing on the lives of others, which is really important to me and most of the people that we work with here. And so building wealth and giving it away is really your opportunity to leave a legacy and to make the world a better place.
And you say it perfect. Dave says to give it away. In the book, he describes don't necessarily loan money to a friend or to family members and expecting it to get the money back. It can cause a lot of issues and turmoil between their relationships. So if you do want to help, the emphasis in the book is to actually give it away, whether charity, to family, to friends, give it away and help them that way if you can. And that's what he says. If you can actually help, then give it away.
Yeah. And if you're in a position where you're on baby step 4, 5, 6, or 7, and you are wanting some coaching, you're wanting some counseling, you're wanting some help with your planning, how can you leave a legacy and really make an impact? Feel free to get in touch with us. We're happy to help. We're experts when it comes to Dave Ramsey and all things that he teaches and coaches, and we are happy to help you. So Dave's 4 types of investments that he recommends are a growth fund, growth and income, aggressive growth, and international. And as you study the landscape and you really look around the investment world, that could be code for putting 25% of your money in the S&P 500, there's your growth and income, putting 25% into a mid-cap fund or ETF. We actually prefer ETFs over mutual funds. They trade for free, they're lower in cost. So 25% in a mid-cap, 25% in a small cap, and then 25% in an international fund or ETF. But if you think about that, 25% large, 25 medium, 25 small in the US plus 25 international, that's aggressive. So yes, over the decades, 10 to 12% is not out of the equation, but in the short run, being 1 year, 3 years, 5 years, maybe even 10 years, you should expect that thing to go down 30, 40% from time to time. If you can't handle that, then this recipe really isn't appropriate for you.
Right. And so most people that we talk to can't handle those swings up and down. So we're seeing mostly adding 2 to 4 additional asset classes or areas of the market to reduce that volatility.
And smooth out that ride. Because the key is you cannot sell when markets go down. You have to ride this thing through. Now, you don't just sit on your hands. You're going to rebalance. So you're going to sell the asset classes that have gone up. So for some folks that have fixed income, that's typically going up when stocks are going down.
Buy low, sell high.
That's right.